we'll start with the US market as a whole, Mark, because there have been increasing concerns or people voicing concerns and using the B word, bubble, more and more often, it feels, over the last few weeks and months. So why don't we start? Can we talk about who's been warning of a bubble, first of all, and why? And then we'll get into maybe some similarities, differences with, say, the dot-com era and take it from there.
Yeah, sure. I mean, some of the more high-profile warnings of late have been the IMF, of course. The Bank of England have come out and said that we're moving into bubble territory at the moment, and perhaps most famously, Jamie Dimon came out and said that there are a number of similarities between the dot-com era and the scuttle for AI that we're going through at the moment. I had to actually give this some thought because e-commerce has been with us for about a quarter of a century now. But I recall myself by the end of the 1990s, I was already organizing holidays online and whatnot. But we couldn't have really guessed the extent to which this was about to expand, and this is part of one of the similarities we see between what's happening now in the dot-com era. I was going to say, at the moment we're seeing a substantial sort of gap between trailing and forward PEs, PE multiples for stocks that are investing heavily in AI. And it's a more limited group than what was happening back in the dot-com era. And in fact, there was no a gap between trailing and forward PEs for a lot of these companies because in many cases, they didn't have any revenues or cash flows as well. Mm-hmm. But where there are similarities is that we're seeing a lot of media froth, exuberance on the part of retail shareholders or retail investors rather. And no one can really say the full extent of the economic consequences of either technology as we're going into them. I mean, of course, with e-commerce, it's apparent now. But back then, it would, as I mentioned, it's very difficult to imagine just how it would change everyone's lives. Both technologies have much broader applications and implications for the wider economy beyond the IT industry itself. And, most famously, we get a lot of articles in relation to potential job losses. But as e-commerce has shown as well, it's also created labor opportunities too. I think it's actually the differences which are more telling between the two technological developments as well, because at this point with AI investors, it's because of the top-heavy nature of the S&P 500. There's fewer participants involved in it. Some of the largest developers of AI technology itself are unlisted too. The main investors in AI technology, well, a high proportion of them have significant revenues and cash flows. So, self-funded investments, there's a much higher proportion of self-funded investments at this stage. The rush to AI stocks has widened the gap between growth and value stocks in the US. There was more blue sky valuations, obviously, back in the year 2000. And of course, this time around, we don't have the widespread adoption of debt for equity swaps, which was a feature of the market back then. You could, the bulls in the market could make the case that based on PE ratios at the moment, the market isn't necessarily that frothy, looking at 10-year averages in that regard. But, I think there's actually some fundamental differences between, the set of circumstances.
Yeah, that's certainly the case. I mean, equally, there are frothy parts of the market, it's fair to say, aren't there? One thing we'll be discussing next week, most likely, quantum computing, while a potentially really exciting area, some of the valuations there are very much getting ahead of themselves, perhaps it's fair to say. As you put it, though, it is also a good point that you look at US big tech, you look at the profitability of those companies, it's very much not the case that they are companies which are pre-revenue or trying something entirely new. They have a firm foundation to build on. I suppose people might draw a comparison in that regard with, say, the telecom companies in the dot-com, where they had an established business, they were building out all this infrastructure, which ultimately was used, but they weren't able to make money from it. It's very hard to say whether that will happen with AI, but maybe the next question is something else we've been talking about on the show and in print online for a while now is, at what point does AI need to start delivering actual productivity gains? At what point do we need to see the actual fruits of this labor or lack of labor, if you will, before something happens? Conversely, I suppose what I'm saying really is, does any of that really matter if big tech keeps spending and beating expectations? We always need a catalyst for something to go wrong, and it's hard sometimes to see what that catalyst will be, other than someone massively pulling back on capex, that kind of thing. But the stakes are so high, it would feel very foolish, even if they want to, for someone like Alphabet or Microsoft to come out at their Q3s in a couple of weeks and say, we're pulling all our capex, because they know what their reaction would be.
Well, you imagine as well that the benefits themselves would tend towards the incremental. And that was probably the case with e-commerce. I mean, you look at a company like Amazon, for instance, and they had a very specific business model that they used early on, where they were just trying to sort of take market share at the cost of profitability, and it's proven to be very successful as a result of that. And it may well be with companies such as Meta and Microsoft that the AI technology that they've been developing is in harness with their existing technologies too. So it will be quite difficult to ascertain the point at which the market's going to turn around and say, well, this isn't justified in terms of cost savings, growth, and so on. It's worth pointing out as well that we're only about halfway through the average bull run market at the moment as well. So, I mean, it's difficult to say what factors influence that, but there's a bit of leeway there, you can imagine. But I'm pretty much just putting my finger in the air if I tell you if there's going to be a sudden point where people throw their hands up, because it isn't quite such a leveraged affair this time around. It's likely to be less of a problem. And we've already seen a couple of minor corrections, perhaps not relating at all to that question of, do the are the investments justified by the returns? So I've given you a completely vapid answer there, I'm afraid.
Well, it's the nature of the topic we're discussing. Will there be a correction or not? That said, it does strike me that when you think of what's happened in the past, it does always tend to be the unknown unknowns, to go back to the old Donald Rumsfeld terminology, rather than the known unknowns that trip people up. If everyone is so worried about this in particular, sometimes it makes me think, well, it'll be something else that actually causes the downturn. We did see a flash of worry a couple of weeks ago, was it, with some US regional bank strains, and often seems it's something like that. We had obviously a couple of years ago with Silicon Valley Bank, things like that, something tangential which causes a bit of panic, something that people aren't anticipating. That said, though, when we look at US reporting season so far, we haven't had the big tech companies who are clearly driving the market or driving market expectations. But you look at Q3 so far, and US reporting has been pretty good in the main. So economically speaking, at least, it doesn't seem the US economy is heading into recession imminently, which was the concern a while ago and has been lingering for some time now. Not in terms of what we're seeing from companies, at least.
Yeah, I guess there's some positive underlying reasons for that as well. I guess the general expectation is that we're going to see credit costs falling further. They've fallen a little bit slower than companies may have anticipated at the beginning of the year. But I think the general assumption in the US is that borrowing costs are going to fall, which is always positive in terms of valuations. I looked at the NASDAQ this morning. They've got, I think it's 58 companies contained within the S&P 500, and they said that 3/4 of the companies that are reporting their Q3 so far have been ahead of market expectations, which is really positive. On that point you made before about sort of left field shocks to the market, I don't think actually, I'm not quite sure what the state of the MBS market in the United States is at the moment, but there were some recent concerns expressed by the IMF and again the Bank of England, I think, about the shadow banking sector. And of course, given, as the name would imply, it's a slightly opaque affair. So if we're going to get some market shocks, it may come from somewhere like that. But we don't really have enough detail to make any sort of determination in that. And plus there was that impasse in relation to China's rare earth exports too, which in itself could drag on valuations eventually. But I don't think it's really in China's interest nor the US to see like a controversy like that expand beyond its natural limits.
No, I mean, clearly political toings and froings are going to have an impact, as they have done this year as well. Just to go back to the third quarter reporting, I mean, it was interesting, the thing I saw, not just beating expectations, which sometimes is easy enough when those expectations get lowered in the run-up to the results, but the overall number of companies doing better than expected relative to recent years, I think was about the best for 4 years. So pretty good, even if you accept that expectations are going to come and go. That certainly things are looking okay at the moment. Equally, that could be another indication of this term that is rolling back out again at the moment, the K-shaped economy, where the well-off are doing particularly well, and clearly luxury as a sector has started to tick up again in recent months. But those at the other end of the scale aren't doing so well. For a lot of companies, that will be okay. For the actual economy, maybe not. The other question, of course, or the other point is that, as Alex alluded to earlier, we are in the middle of a US government shutdown. We don't have as much data as we normally would on various parts of the economy, so we are flying blind a little bit. We'll have to see how that plays out. The final point that I wanted to make is, which we should say, given all this talk about bubbles and valuations and that kind of thing, is, I mean, it's a rote point at this point, but the importance of not trying to time the market when we're talking about these things. We're clearly not saying people should, even if they are concerned, take all their money out the market or divest and things like that, because that's very much not the way to invest. I think you agree with that, Mark. I think that's fair to say.
Yeah, it's a drum that we beat quite often there as well. It's probably worth mentioning too that US companies tend to report ahead of us in the UK too, so we'll have some further information we can revert to in the weeks to come, to seeing if this holds true for the UK.
Indeed. And it is also fair to say, I suppose, despite the good reporting season, that if tech were to have a bad reporting season, that could bring the whole thing down. But yeah, as we say, that's not really helping anyone in terms of advice. And the big problem with timing the market, I think people always think, is they think, oh, I've done well taking money out, say, at what proves to be near the top. But the hardest part is not doing that. It's knowing when to get back in again. And that creates a massive issue. And people won't know what to do. If they take money out now and then the market goes up 10%, they'll probably want to put it back in. And it's very difficult to make that decision at that point, isn't it?
Yeah, I was talking to James Norrington about dollar cost averaging the other day as well, which is a subject we can cover in the future too, to flatten out those risks.
Indeed. A little bit every month is probably sensible.